I'm even on the camp where I don't think the Fed should cut in September. The economy, nothing's popped. And everyone's saying, well, the Fed has to get ahead of it. And Elon Musk says, you got to do it now. And I'm like, the Fed has never been in front of any of these things. They always lag on the downside. You know, you're starting to see Chapter 11s increasing here. We've started to see a lot of Chapter 11s increasing in Canada. And you're seeing those Commonwealth sort of adjacent countries that are sort of less strong than America all start to cut and degrade. And so they're going first. So I think America will go. I'm just like, is it next? Is it September? I don't know. The market is becoming a trader's market. If I was trading again, I would love this market. It's just like so much opportunity. Very frustrating if you're investing in this market because your time horizons is sort of going all over the place.
Welcome to the On the Tape podcast. Guy Adami, always joined by Danny Moses. Danny, how are you?
Great, Guy. How you doing? I know
There
not
was,
so well.
there was no sincerity there. Dan Nathan, how are you?
Fine as usual.
We have an exciting On the Tape podcast for you today because we are joined in studio by the great Stuart Sopp. I just like saying that. He is the founder, co-founder or founder?
Co-founder.
Of Current. And he is so well equipped to talk about all the things that have transpired over the last couple of weeks that we knocked on his office door and said, "Hey, Stu, why don't you come do the?" Didn't we do that?
Yeah.
No,
Some might
we didn't
argue
do that.
he's not that well equipped.
Definitely not.
I think you're well equipped. Now,
No, I don't mean for the content.
you were not born in the Etat Unis, is that true?
That is true.
So for people like me, like just curmudgeons like me, if you're not born here, you're basically from someplace else, all get lumped together. But there's a band that I've actually grown to like. And the name of the band is Oasis. Are they like Irish or something?
They're very close from Manchester.
Manchester. That's close enough. But you were probably an Oasis fan. True or false?
I was definitely wrapped up in the Oasis buzz when they were out there.
The
yeah.
Gallagher brothers.
Yes, they hate each other.
They cannot stand each other. But we love you. But I mention that because, you know, you hear Dan Nathan all the time, and it makes me want to scream.
I know where you're going to go. Climbing a wonder wall of worry.
Climbing a wonder wall of worry. That's exactly
I'm so
right.
in your
The
head.
market continues to climb this wonder wall of worry. And I got to be honest with you, Danny, you said you're in a bad mood to me about 35 seconds ago.
I said you're in a bad mood.
That's what I mean.
Yeah, get
I
angry.
am
Let it out.
because... you
Release your anger.
I'm not releasing my anger, but you go back to last Monday when you had that huge downdraft in the market. The VIX traded up to 60, and here we are on a Thursday afternoon. It's like nothing ever happened, Dan. It didn't happen.
Yeah. What's the story? Morning Glory.
That's the album.
Yeah.
I believe 1994-ish, or no?
Yeah.
It's got
Danny's saying get out.
Speaking of the mic.
It's not even close
So
to you.
one thing is, and so Guy, you know, I know you're messing around a little bit. One of the reasons why we're really excited to have Stuart on right now is like the consumer is taking center stage in this whole story about what the Federal Reserve is going to do or not. And Danny, you know, you've been quoting a bunch of data. You know, auto delinquencies are up. I mean, there's a whole host of things that on one side, you can say the consumer is clearly weakening. Q2 earnings period, we heard it again and again and again. Not so overtly, do you know what I mean? But there were kind of hints of that sort of stuff. On the flip side, you know, you look at this consumer data that we got this morning. This is Thursday. Consumer spending is up much greater than people expected. So, Danny, talk to us really quickly about what you see as potentially seasonal versus the potential for a pickup when we kind of hear Q3 earnings in October, and we're kind of getting there.
Let's just talk about the overreaction to everything. Starting with the jobs report almost 2 weeks ago, comes in, 100 and something thousand, and the world goes into a panic.
Well, that's initial jobless claims.
No. The monthly job report.
That Friday jobs report.
Got you guys.
2 weeks ago that came in. So reset it from there. At the same time, the yen was strengthening, and the combination of the weak U.S. economic data with the strengthening of the yen basically exposed the carry trade, and we had a little bit of a reset. So everyone's clamoring, 50 bips, emergency cut. Don't wait till September. Fast forward to a retail sales print and 2 weekly jobless claim numbers, and now Fed funds are pricing at a 75% chance of 25 basis points only. Zero chance of zero, by the way, just to be clear, and 25 chance 50. But more interestingly, at the end of the year, it's now less than 4. We were approaching 6. The crazy thing about that is if we're on that, not sure footing, if things are that uncertain and we're trading the markets like we are, down 2%, up 2%, up another 2%, up another 2%. At this moment, I feel like the movie Stripes. And I think when Sergeant Holcomb
Please.
falls off the tower,
That was when-
and he lays down there, and
he's
John Candy
grunting.
comes up to him, and he goes, because it really feels like that at this moment. Holcomb.
Might we bring our guest in at this point?
Well, let's bring
you
Stuart
asked
Sopp.
I know, but one of the things I'll say is really interesting. Why, I think Guy said you are well equipped to speak to this stuff, because we're seeing the weakening on a consumer that I think is your customer. They've had a tough time. You guys describe them. I'll let you describe it in a certain way, but it's usually FICO 650 and below or so.
That's right.
What, you've come in here, I think every quarter and you gave us a sense of like how this consumer that lives paycheck to paycheck, they don't have a lot of savings, they're not in the stock market, that sort of thing.
Mm-hmm.
What's your read on what's going on? If you were a publicly traded company and we had just listened to your Q2 earnings, how would you categorize the consumer that you serve?
Well, those two things are pretty correlated. So, if you listen to our Q2 earnings, I did our board meeting last Friday, so it's very fresh in my memory. But we've seen year-on-year growth of something like 100% in revenue,
Wow.
over 100% in contribution profit, and over 100% in user growth. So that's really good for Current as a business. When you look at the kind of consumer that we're servicing. It's affordable liquidity when the banks are not there, and the banks have all pulled their socks up, haven't they? They've sort of said, "Hey, anything near prime even is not where they're sort of servicing it." Even though you've seen credit card balances rise something like 2.4%, I think was one of the stats that you're trying to get to a record high of $1.14 trillion. That's a big number, but really, we're just resuming the trend of all the pay down of debt that we saw in COVID, right? So for those 2 years, everyone went straight down, everyone paid off their debts because they could save money by, working from home. And plus we printed all that money and cut all those checks to people. So they paid down their debts. And we see that very often on a seasonal basis in our business in tax refund season. So people get refunds, they actually pay down their debts. And so you've seen sort of a macro view of that. And so for the broad-based consumer, like the average customer, which we do not serve, I think you're just seeing a resumption of people taking debt. For our customers, they're finding liquidity through services like Current, and they're doing okay still. The spend is still there. The jobs are still there, even though we saw that, I think the jobless rate, didn't it go to something like 4.3 in July?
Yes, it did. Went from 4.1 to 4.3.
Yeah, so the details of that, again, I think all these jobless numbers, conspiracy theory hat on, it gets really political quick, but it's a birth-death ratio and they play around with all this other stuff, and it's really kind of sort of almost fake. And so you really have to dive into why it's moving a little higher. We're not seeing jobless in our business at this point. In fact, what I think is happening in a broader-based sort of thesis is like what's happening with Walmart. Walmart's doing really well because they're downsizing. People are going, okay, I'm not at Target anymore, I'm at Walmart. They're saying I'm not at JP Morgan, I'm at Current.
That's exact. I was going to make that exact. So thank you for doing it. What I was going to say, I was going to compare what's been going on with Walmart. And if you think about it, I think 65, almost 70% of their customer base now makes $100,000 or more. And if you think about that 10, again, I understand inflation, I understand all those things, but 10 years ago, that was not even a glimpse. Like there was no chance of that being those type of statistics. So people are coming down in the same way they're probably coming down to you. So it's not necessarily bottom up. It's more middle down to you, which is great. By the way, congratulations. That's great for your business. But when you sort of take a step back and look at it, what does it tell you, do you think? That you mentioned it, that things are probably not as strong as some of the data suggests.
Yeah, I think it's this like macro thesis of shrinkflation. Everything's getting smaller, everyone's downsizing, and I think technology is, especially with some AI. I've been one of the biggest skeptics of this whole bucket, right? But you saw it with Walmart showcasing some of their AI stuff, that they're saying their logistics are improving and Palantir ripping on all their SaaS business sales, right? And so you sort of juxtaposition those kind of things. I think you're seeing technology really playing a very important part in the sort of deleveraging and downsizing, shrinking, and efficiency mechanism of the broad-based economy. I think that's what's happening. So whilst maybe 10 or 20 years ago, we would have had a hard landing, maybe we are having a soft landing. Maybe it's a soft recession because we're able to adapt to these changes through technology.
All right, really quickly. So last week on OK Computer, your co-founder, Trevor Marshall, who's also the CTO of Current, he and I had a great conversation. Very much what you just alluded to is how companies are using generative AI, some of the investments they made. And, this is one theme, I think, in the Q2 earnings also is that we're not seeing a lot of monetization just yet. And so I know that this is something that technology has been very important to how you built your business and the products that you serve. How are you guys thinking about that right now? Because again, there was a lot of processes that you were leading or that you were using that led to some of these advancements in generative AI. What sort of pressure as a CEO do you have to keep up with some of the technology, and how are you deploying it? Are you seeing those productivity and efficiency gains?
Yeah, we are. So in short, a lot of our recent performance, obviously the TAM, the addressable market, is increasing, right? If you're on $100,000 paycheck to paycheck at this point, and you need affordable banking, that's just like a tailwind we're seeing from a technology point of view. And I'm sure Trevor's podcast, everyone should listen to it because it'll be far more in depth than what I'll give. But we're seeing gains through traditional things like our member experience, customer service, right? And so deflection has gone up to like from 15% to 50%, right? So that's awesome. First touches are now AI assistants effectively. We can also, by the way, make that from a cost center to a profit center because you can actually cross-sell. You can cross-sell seamlessly with like big data and all the rest of it. So that has been amazing. We are good customers, I believe, of GCP, Google, and we use their Vertex AI modules. And so we've got a bunch of models that are being continuously trained and tracked and all the rest of it, and deployed in anti-fraud measures, payroll prediction, job prediction, all these things that make us really, really efficient. So we don't have to hire as many people, and also we can get better quality customers and give the customers a better quality of service.
So you've recently launched the loan product, right? And what's the uptake been on that? I know it's not a huge part of your business, but are you using AI there, or are these existing customers that are now using this product?
Yeah, so we launched an earned wage access product, not lending, not credit, just for any regulators listening for us. No recourse, no recourse, and no no fixed fees or anything like that. But yes, in short, it has been a game changer for us, tying an earned wage access product to a credit builder product. That's really what's happening here is you get access to liquidity if you move your paycheck over, so we get cash flow underwriting and also some ability to get some money back under the terms and conditions. And then two, they're building credit with every swipe. So you combine those two things, banking and liquidity, which are very often, it's weird, it doesn't really happen out. Banks don't really do that, right? They have these separate lending divisions and all the rest of it. When you combine those two for people sub 620, 650 FICO and below, it's a very powerful growth tool.
See, it's unlike Upstart, which I've talked about ad nauseum. Upstart is a bank, basically. They're just a lender, and they pretend to be a tech company, and they've convinced
to get
people,
the multiple. Yeah.
Right. Thank you. But in the risk section, all there is bank topics. All they talk about is funding. They talk about securitizations. You don't have to deal with that because the scale that you're doing is nowhere near that, and you're not balance sheeting yourself these loans per se. But
you're right.
Right. But I'm saying you are doing this the right way, and I think that this using AI in general for lending just is going to come back to bite people. I think that are growing too fast, I believe.
Yeah, I think it's unproven whether AI underwriting is is more pixie dust or is there real something to it. I don't know. Everyone has been using alternative data sourcing and cash flow underwriting in our business forever, for like 20 years. So I don't think there's been any particularly new innovations in that space. And of course, we're not a bank. We're a financial technology platform. And the majority of our revenue is payments. So we make money through interchange. So that's why we ask you to be eligible to move your paycheck over to us to go and get some of that liquidity from your paycheck.
Your data probably gets pretty granular. What do you see geographically in terms of the country? Like, are there hot spots? Are there places that have slowed down considerably? Where's the growth area? Can you speak to that?
It's broad-based still. We are primarily like urban into a little bit of suburban, definitely not rural. We're basically, if there is a nucleus of people, that's where we are, which is broad-based America. And then we over-index in states like Texas, gets political quick, Dan, and then Florida and sort of the South.
That's a separate podcast.
That's a separate podcast.
Yeah.
But we over-index. We obviously do really well in California, New York, and the rest of it. But at the moment, no slowdown. Like, not in terms of our acquisition, our conversion funnel, and then there's no slowdown in terms of draws. The one interesting thing, which is hard to separate, maybe it is macro, maybe it's not, is the amount of the dollars per draw has steadily increased over the 6 months. Now, we're enabling that because our risk systems say it's okay. But it's hard to separate whether people just need more cash, right? So like there's that, right? And you're seeing that through people who can get or should get credit card balances. That has also gone up, like we said, 2.4%. It's that kind of number. There is a steady increase. I don't think we're breaking anything yet, but like there is demand. There's an incremental increase in demand month on month.
I think the average, real quick, I think the average amount on a credit card in the United States is now almost $6,700, which is significant. I mean, it might not sound like a lot, but it's a lot. And when you're talking about an average rate, I think approaching 22%.
Yeah.
I mean, you could see how this thing unwind. Well, and but I've thought that for a while. Why don't you think that has impacted? Forget about the consumer for a second. The broader market doesn't seem to care about this.
Yeah, I don't. Yeah, I think everyone is waiting for cuts. You remember last year, I think October, November, we priced in 6 cuts or something. You remember that flash sort of thing? We're doing something similar now. I don't think that. I think there's a lot of money in the system. I think when you've printed so much, inflation has notionally, like rate change, as we have seen, has come off. Thank you. But the absolute rate is still very high, and there's a lot of money in the system. And at interest rates at 5.25%, whatever it is. There's a lot of people who are savers making a lot of money risk-free. And so that is still circulating, still doing its thing. So I think we always look at the poorest segment, which I appreciate, but there is also a very rich segment in America that's still doing extremely well.
I think until people start caring about the debt deficit, none of this will matter. Something really interesting happened. Love to get your thoughts on this, just to shift a little bit to the macro. So this whole crisis, I've always said that the central bank experiment started in Japan and it'll end in Japan, but something really interesting happened earlier this week that I didn't really see get picked up a lot. So Tuesday morning, like 2 a.m. our time, it was reported in Japan that the head of the BOJ, Ueda, will be speaking in front of Parliament. They're going to bring him in front for what he did by raising rates, God forbid, to point to. Hold on. August 23rd, okay? Also on August 23rd is Powell speaking at Jackson Hole. So to your point about we were just kidding, we're going to have plenty of liquidity. It explains Guy's frustration, my frustration in terms of this market just finding its natural place and certain stocks finding their natural levels. We are still fighting this global liquidity. You just made the point. And, people claimed a crisis when the market was down 5%. What are your thoughts on that in general? And it's not so much do you fight the Fed, it's just when is it going to matter finally, you think, these levels of debt out there?
I think it's so hard. And I don't, the question of when debt matters, I think is when it's all on the bond market, right? It's all just bond market confidence. And I don't think we're there yet. And then what else are we going to do? There's nowhere else to park your money as well, right? So,
well, gold, we'll talk about that a little bit.
Well, if gold goes through 2,500, technically, I mean, that's very exciting for everyone, right? The metals go up. I just think we're at the stage where I'm even on the camp where I don't think the Fed should cut in September, even though the twos are at like whatever 4% now, banging around there. They went down to 380 or whatever it is, and it's implied like 100 and some basis points cut in the near term. And I'm like, the economy, nothing's popped, and everyone's saying, well, the Fed has to get ahead of it. And Elon Musk says you got to do it now, and I'm like, the Fed has never been in front of any of these things. They always lag on the downside. And so like nothing's popped. And, you're starting to see Chapter 11s increasing here. We've started to see a lot of Chapter 11s increasing in Canada. And you're seeing those Commonwealth sort of adjacent countries that are sort of less strong than America all start to cut and degrade. And so they're going first. So I think America will go. I'm just like, is it next? Is it September? I don't know. And they're not going to do, well, if they do 50, I'd be very surprised.
Yeah, well, Fed Fund Futures, the CME Fed Watch, has basically pricing a near certainty of 25. That's why I think next week at Jackson Hole is so interesting because we've seen some really good indications in the past, or obviously pivots at that confab. And, I'm in that camp. I know Guy is, I know you don't want them to do it, or you don't think they should do it. And it went from, Fed Chair Powell said this a while ago, that we are going to start to ease before we get to our 2% target. And I think that sort of, mentality is one reason why people feel like the September is the time. I think for political reasons, I think it would be a mistake right now, and especially if we have conflicting data. I wanted to make one point, though, when we talked about, a potential soft landing, and, there's obviously beneficiaries in the stock market, a whole host of it. And a lot of folks, if we had a hard landing, we're also looking at the Mag 7 and say they're kind of recession proof. And one of the things that's interesting to me right now, I'm looking at a NASDAQ 100 that's up 16% of the year. I'm looking at a NASDAQ composite that's up 17% of the year. And then if I look at the Mag 7, look at this. Apple's up 17%. Microsoft's only up 12%. This is on the year. Google's up 15%. Amazon's up 16%. Tesla's down 13%. And then you have NVIDIA, which is an outlier, up 146%, and Meta, which is up 52%. So think about that for a second. We're starting to lose some of the leadership, especially on a relative basis here. So how are you thinking about that? Because I know a lot of companies like yours are using GCP. They're using AWS, right? And they're using Microsoft Azure, but those stocks are no longer outperforming the stock market other than, the ones that I just mentioned.
Yeah, I think it's what you're saying is right. The generals are starting to break away and it's becoming idiosyncratic. And I think more broadly, the market is becoming a trader's market. Like if I was trading again, I would love this market. It's just like so much opportunity. Very frustrating if you're investing in this market because your time horizons is sort of going all over the place. I think NVIDIA just is expensive. I just think it's expensive. I'm not obviously in that at this point. I think Meta is a great company. I think they've had like a lot of internal change. They've had optics change with Zuckerberg. We use them for like targeting for Meta, Instagram ads and acquiring customers. And of course, with the privacy thing in 2020, I think it was. You remember when Apple did the whole thing, completely broke targeting, right? And so what they did is they invested, what Zuckerberg did is invest in a bunch of these GPUs and did AI.
For Metaverse or initially.
So it's for Metaverse, but like what I heard, and this may or may not be true, so it's like a rumor mill, but he actually did it under the guise of Metaverse. He never really believed. Now he could just be like retooling history here, but it was never really for that. It was really for the targeting of his ad business again. And he didn't want anyone to follow him. They all thought like if they followed the Metaverse, they'd be a lame duck sort of thing. So it's believable. I could believe it. Because the AI ad targeting that they have developed now is now better than it was in 2020.
And manifested itself in this last quarter. I mean, they actually said,
going.
yeah, and good for them. So let's go back to your prior life. And, Danny mentioned gold. I saw your eyes sort of light up. You think about the currency moves we've seen. We've been discussing Japan for a while. But, again, I'll say this. All roads have been leading to gold and continue. What do you think it's telling you with the amount of gold central banks have been buying over the last few years? What do you think they're positioning themselves for?
Yeah, the hard money. The BRICS nations are, accumulating gold, and they're just going to this side of the ledger where they're not buying U.S. treasuries. That is not money anymore. I've said this a few times. Gold is now money again, hard money. And so you're just going to see this discrepancy keep going. I think you're just going to see two worlds. It's like the Western world on the dollar and everyone else on gold. And eventually, worlds will collide. I think you'll see gold at, through 2.5, it'll go to 2.8 pretty quickly, I think. And then silver, the sort of mad dog follower, the ETH or the shitcoin of the precious metals. I think you could see bigger gains through that as well. And there's industrial uses through EVs.
In silver, there absolutely is.
Yeah, battery innovations now are using more silver.
I don't know if you noticed this. No one's buying EVs anymore.
Yeah, well, no one's buying any cars. Yeah. If you're looking at big purchases, this is the shrinkflation thing. It's like people are just stopping on the big housing as well. Look at lumber. Lumber's down something like 80% in 2 years. You saw the same thing. And so that's a massive leading indicator of home buying, home construction, renovation, a major lever on a traditional household's wealth. And it's at the gutter. And so I think I think we're at the point where we are hurting the consumer and the economy. They are going to debt to fill that, but it's not at the popping point. It's not like,
what does that look like? Is that I don't want to say a failed bond auction, but that's a term people use. So lack of not failed, but a terrible bond auction where it spooks people. Is that sort of the trigger, you think?
Yeah, I think in the professional market, it will be post the election. I think what will happen is depending on who wins, but it doesn't actually matter, actually. Harris or Trump winning. Whoever gets in is going to spend a lot of money. And so they're both sides have proven that they're sort of almost fiscally irresponsible. And I think after that budget in Jan into Feb, and then obviously there's no Fed meeting in January, so it'll be February next year. I think all the professionals will be lining up to like, okay, what are we doing at this point? Because if they're just going to go and spend money again, I think we're getting sort of toppy on the debt. 35 trillion every 100 days.
Well,
no one's got a.
Is that what it is? $1 trillion every 100 days?
Yeah, we effectively uncapped the debt ceiling in 2023 through the election in 2025. To your point, so we don't have to deal with it again until next February.
Yeah.
That's the point when it's going to matter. And so back to Bank of England, Liz Truss loses her job because she wants to put energy price caps in and cut taxes, but that doesn't work for the budget.
Yeah.
Japanese prime minister is now stepping down because there was a little bit of something happened there with some fundraising stuff, but also they didn't like what the market did in reaction to his leadership. So now he's gone. But no matter what party comes in, to the point that we're kind of making, there are no tax cuts coming because the odds that the economy is accelerating through and that the gross tax receipts will give enough leeway in order to kind of do that. It's not going to work.
Well, if Trump wins, they're definitely going to extend those tax cuts.
Depending on what happens in the Senate and the House, right?
Extending credits extending that's a little bit different, right, than saying we're going to cut, we're going to do this.
Well, yeah, but if they do 1.4 trillion again, just throw that on the deficit. I mean, really, because we're not going to grow our
but
way
you have
out of
to
that.
you have to cut things. You either have to cut defense spending. That's not happening.
You're
not cutting
fiscally responsible. It's already gone.
I get it, but my point is that, and this all goes back to gold again, all this stuff, is when that does matter, when the realization comes in, and again, that's not for this, that's not for now, right? I want to go back, I want to take it back again to a point that Dan made on the leadership of big tech. So about a month ago, we had that rotation out of tech into the kind of the Russell and the small caps, and then you had the big sell-off, and everything sold off, the bond market rallied, everything sold off. The point you made about stock picking, and you're right now with all this volatility is tremendous. More so even on the long side, when the water goes out and everything's just in a passive fund and gets taken out. There were small caps that were down 25, 35% on the market being down 7%, right? And that's a huge opportunity to your point. And so not to get lost in this, we talk about down volatility, up volatility. People need to understand what they own and use single name, bottom up, and they're huge opportunities. And same thing on the reverse. Now you're getting a huge move up, probably overbought conditions on some of these names. People need to be nimble and look at these things and really understand what they own and not get married to these things, right, that they own. So I think I just wanted to bring it back to the point. It is hard you make because it's, the portfolio management.
So I want to make one point really quickly. So going back to that leadership that you just mentioned, Danny, August 28th, NVIDIA is going to report. And I just mentioned this again, I'm just going to redo it. Microsoft, 12% of the year, Google, 15% of the year, Amazon, 16% of the year. Those three make up maybe 30-some% of NVIDIA's revenues. Okay.
Customer base.
Yeah. So think about that. Okay. So if those stocks are underperforming the markets, that means that investors, right, are considering the sort of slowdown, you know what I mean? And maybe that is in revenue and monetization, which will lead to a slowdown in CapEx. So to me, if the last man standing really is, for all intents and purposes, of this whole Mag 7, NVIDIA, and you just mentioned the reasons why, Meta is up the way it is, like that really turns into, I know we've said this every quarter for the last year, but NVIDIA's earnings are going to be really big. It really feels like if investors are placing that sort of emphasis on their customers, that NVIDIA has the potential to possibly guide down or not come up or not come in as high as some folks think.
And just to add to that, let's be clear about the wealth effect and people's mentality calling for Fed rate cuts. It's the stock market going down that people are clamoring when nothing actually is that wrong. I mentioned before the overreaction to a bad job number, the overreaction to a lower than expected initial jobless claims. Let's not kid, it's the stock market. And the stock market has its tentacles now, much bigger part of kind of the world in the US than it had prior to COVID. And so I think part of this craziness is not understanding the plumbing, getting cut up. So to Dan's point, if NVIDIA were to sell off and the market were to come in, all other things being equal, Fed, you got to do something. You got to do something. And that's not a healthy way to trade the market or think about the market.
I think you're 100% right. And the Fed that I grew up in was far more divorced from that kind of political or like pandering to the consumer. I think the Fed gets really scared when bank stocks go down. I think that's like the only sector that they really care about. And you saw in the dollar yen deleveraging, which Goldman Sachs, I think, said is 90% done. I think everyone just put the trade back on. That's what it looked like. VIX got crushed. All those machines, those VAR shocks that you have in hedge funds, they all went flashing,
Duke and Duke.
flashing right.
Turn
right
those machines back
and then
on.
it was like bright green. And like, we're back again, right? But you did see MUFG down 20%. And I think that's when you get like a BOJ guy being hauled in because the banking system is the biggest bank in Japan that is trading like, dog with hat, right? It's like, it's like a meme stock. And so it shouldn't be doing that. And so I think that's the warning sign for the Fed. I'm sure they're watching the bank stocks very, very carefully. in the US. But Nvidia, I think they're like, go for it. And just one last thing, I think, due to you saw the yen carry trade, was, those Mag 7, those big stocks were like major beneficiaries
Agreed.
of that levered trade. And you saw them sort of flash crash on the day and then everyone come back in, just like in the cross yen trades as well.
I don't think that's at all coincidental. And I think you throw passive investing into this whole mix, which obviously those same names have been huge beneficiaries of. You mix it all up and you wonder that, again, if we see another circumstance like this, which, by the way, JP Morgan said the yen carry unwind was 75% over earlier this week. I don't think that's true, but we'll see. I think there's a stabilization now. I do think there's another leg here. And again, when passive becomes active, it's never active on the way up, Stu, as you know. But let me ask you this, in terms of your business and the things you watch, at the epicenter of everything in terms of the United States is the job situation. And we talked about it earlier, but when do you, forget about the Fed, when do you start to get concerned in terms of the unemployment rate? I mean, Dan and I have talked about this before. Historically, we're still at pretty low levels, but when does it start getting a little dicey for you and the lens that you look through at current?
Yeah, that's a really good question. So on a macro level, it's like 5%. That was always traditionally, where you'd go, we're beyond full employment at 4 point, whatever it is now, 4.3. So I think you've got some room to go on that. And I think the devil's in the detail nowadays, because if you look at some of the data of like foreign workers, like it gets very political again, like who's got the jobs and all the rest of it. There is correlation to lower income, need for a digital bank, non-traditional. So, I think current is a beneficiary and will be continually a beneficiary of the dynamic of what has happened in the country over the last 5 years, and will continue, I think. Not necessarily, even if you close the border tomorrow, there's like a lot of people who need bank accounts, who are looking for gig economy work, who are trying to make ends meet, right? And so like from a, job loss from our biggest customers or our biggest employers, they're everyone you'd expect. So it's like the government, right? So to Danny's point, are we going to start like cutting DoD spending and then start firing, Marines and the Army? I don't know. I don't think so yet. And so like if that happened, I would be looking at our data very carefully. There's Walmart and Amazon. They're getting smarter about, their manufacturing and their factories and automation, robotics. But we've only grown with those employers over time. And so, anything in logistics and things like that, I think are always kind of in demand in this new world, because so much is like, press a button and get it delivered to my house. No one goes to the store anymore.
So the changing demographics really work to your benefit here. I mean, so the world is we've thought that for a while, but I think it's been sped up over the last 6 months in terms of probably what you're seeing. You mentioned that growth earlier, but now you're starting to see, I would imagine, the fruits of your labor, and the world is lining up exactly the way you need it to in order for current to continue to be successful.
That's right. Yeah, it was one of those rare things where you make a macro bet. You used to just put trades on, and this time we built something. We built a business towards a macro bet. So not everything went exactly how we thought it would in the time we thought. Some things were delayed. Like, for example, COVID sped some things up, but delayed other parts of that bet. But yeah, it's nice to see it, actually happen.
So you have a secular growth story, because to the point you made about job growth, you're more exposed to blue collar type workers, not white collar. The job losses we're seeing right now are mostly coming, at least the ones we see that are announced, are white collar workers, right? So
that's it.
You actually can benefit almost from that, because it seems like there's job gains potentially on the lower end.
Yeah.
So I would imagine that what about buy now, pay later impact on your group? Imagine it's a positive for you to someone to have another source potentially of liquidity, or how do you guys measure that, and what are you seeing in that?
In terms of like charge-offs of that, or
in terms of the health of how many of your clients are also using buy now, pay later?
Yeah. Okay. So we're not about to, but we're also looking into developing a product very similar, because it's a heavily used product and we think we could do it better. So I'll just leave it at that. But BNPL, they have multiple sources of leveraged income. And so, whether it's Dave or Moneyline or, a BNPL offering of some kind, a firm, et cetera, et cetera. The difference that we have is that we require the primacy, the job, the actual paycheck. So, it's easier for us to get paid first. And of course, what it ends up looking like over time, I think, not for us, but I think in the market, is when you're connecting your sole bank account to a bunch of disparate third-party lenders, shadow banking, whatever you want, private credit kind of things, it ends up becoming more like high frequency trading, because when that paycheck hits and who's in the stack, and it becomes like a latency issue. We're seeing it down to like 15 to 20 minutes of like 1st to 14th, something like that, with some of the things we've seen. I think it's going to get into the milliseconds. It's going to be a very interesting future.
Yeah, let's get back to the markets here for a second. So again, we talked about kind of like what happened early last week, okay? And it really did seem like a panic on, it was August 5th, it was Monday, right? So here we are, it's Thursday, into the close. We're probably up about 4% or so on the week. We're a little more than 2% from those all-time highs. And I guess this is for maybe Guy, maybe you can help me out here a little bit. So we have this data this morning. Stu just said it looks like, at least through his purview, that we might be more on path to a soft landing than maybe some of the folks who thought we were on the path on August 5th to a hard landing, okay? So why is the market rallying the way it is on something that is basically pushing out rate cuts, all right, a little bit? Because we saw the market rally on bad data that suggested the Fed was going to cut more. Like, help me, I'm looking at Danny and Guy, help me understand this, because the market is raging for the last few days.
Yeah, we're back in the paradigm where both good and bad news are good news for the market. I mean, clearly that's what's going on, number one. Number two, it goes back to what Jamie Dimon said with Leslie Picker. I think it was last week in Kansas City when Jamie Dimon said that market pundits and the market in general in his opinion, put way too much stock in not only what the Fed says, but what they do as well. And I found that actually sort of interesting. He doesn't think it's nearly as important as people like me seem to suggest. And I will tell you, the behavior of the market sort of backs some of that stuff up. But in terms of soft landing, again, I'm not an economist, but if you look at the leverage in the system, just in terms of, consumer credit, debt to GDP here in the United States, the fact that Warren Buffett now has the biggest cash hoard that he's had, the fact that he sold, Dan, you probably know this, I think half of his Apple position, he's paring down clearly some of his banks. I mean, that does not suggest somebody that's thinks the market's going to continue on its merry way. That's somebody that says a storm seemingly is brewing out there. We just haven't seen it yet.
I'll take a shot at it. So at this point, it's more important that there's economic growth, basically, to validate where the stock market is right now in terms of the multiple. And the second part of that thing is that the Fed cutting really is not going to do anything, 25 or 50. So I think, Dan, to answer that question, I think the soft landing, I've said this for weeks, I think we've already had it. I don't, it's been long enough now since this rate cycle, they stopped raising, to call it what you want. You can have a normal cycle at some point. It doesn't have to be tied really to this. But I think we've seen glimpses. The stock market is going to react worse on bad economic data because the belief will be that the growth is going to slow. It's all about the U.S. consumer. People are very excited about retail sales bouncing back like they did today. So my feeling is that you basically have to validate where this market is trading, and a weak consumer or weak numbers in the economy will make the market trade down precipitously because a Fed rate cut really won't do anything, in my opinion, at least to cushion the blow. That's what I think. Stu, what's your thought?
Yeah, it's totally reasonable. It's kind of where I'm. The only thing I would say is I've said there's been no pop yet, but I do think if I was to take the other side and try and spot where there's weakness, I think we have a bit of a crisis in food and shelter. So you've seen the Starbucks move, right? So they've taken the Chipotle CEO. That's more shrinkflation, more digitization. You've seen a Subway emergency meeting due to their franchisees increasing prices, and you saw McDonald's now having to do a $5 thing because they went to $18 or whatever it was, the Big Mac that I saw Dan eat the other day. And you're seeing 30% of hourly workers earning less than $15 an hour. That was 32% 2 years ago. So I think, and the shelter is exactly the same story. Like no one can get on the house, lumber's down, no one can buy, all the rest of it. And so food and shelter, I think, are really interesting at this point because the private sector or the public markets are trying to buffer and adapt to it because they know that they can't really raise the prices. But what's looking like it's happening is hourly wage growth is going up, and you start to have that wage inflation cycle that the Fed will be terrified of. So when you talk about cutting, I think they are taking that into account. They're like, if we start cutting and it doesn't really do anything, inflation starts ripping again. Like we're in a whole hell, a lot of trouble.
All right, listen, on this note, we get a preview of our main man, John Butters. He's the senior earnings insight analyst over there at FactSet. His note drops every Friday morning, but we, like I said, get a preview of it. And here's a good segue from what we were just talking about, what John is writing about this week. So he said, the term recession has been cited on the Q2 2024 earnings calls 28 of the S&P 500 companies. That's it. Okay. So I think that's kind of interesting. The number marks the second lowest number of the S&P 500 companies citing recession since Q4 2021. We know it happened right after Q4 2021. However, this also marks the first, and he says, slight quarter-over-quarter increase in the number of S&P 500 companies citing recession since Q2 2022, prior to the release of the non-farm payrolls unemployment number on August 2nd. The term recession was cited on the earnings calls of 17 of the 500 companies from August 2nd through August 13th. This term recession has been cited on the earnings call of 11. Okay, so those are not big numbers, Guy, but talk to me about that, because again, it seems like also some of the market sentiment numbers, they're getting really low. It seems like we're getting to a frothy sort of situation.
So a couple things there. I mean, if you think about when companies were citing inflation in record amounts in terms of S&P 500 companies, effectively that marked the top of the inflation print. So one can then say, well, wait a second. Now, none of these companies are talking about the potential of recession. There probably is about a contra indicator, as we saw with the inflation, number one. Number two, in terms of positioning, Lori Calvasina, who was on our podcast a number of times, she was on Squawk Box earlier this week, and she brought up the fact that positioning, even with that huge drawdown on Monday, has not effectively changed in the market. The market's structured the same way it was prior to that. So longs and shorts are still what you would have hoped. I think if you continue to be bullish, you would have flushed a lot of people out, and we have not. So those two things together suggest to me there's still some downside, a lot of downside in this market.
I would just say, as it relates to the earnings and the mentions and all this thing, you look at the companies that are executing versus the ones that aren't. And the ones that aren't executing right now, I think are going to be hard to own any of those. But the ones that are kind of getting rewarded, I'll bring up a couple of these names. Walmart, which we just touched on briefly, they brought in the middle income consumer into their stores. And what's happening now is certain costs of certain foods have come down. Strawberries have come down, certain things. Walmart's now blaming some of the processed food companies for not lowering costs. But what's interesting is that these customers are now buying other things in the store, the higher margin products. And that's what's going on right now at Walmart. I flip it to a JetBlue, right? What I'm saying is if you're not operating now in one of our best economies of all time in the services sector, you're screwed. They're selling debt at 10%. The equity,
JetBlue is.
Yeah, the market cap's $1.6 billion. Their debt's over $5-6 billion at this point. And I was on a flight yesterday, and I heard flight attendants talking to each other.
JetBlue flight?
JetBlue flight, bitching and moaning. The emails that they were getting, I was waiting for the bathroom. It was a very crowded plane, by the way. And they're talking about how when they go to Orlando now, if you live in Orlando and you can't stay at JetBlue University anymore, they don't pay for that anymore. You have to stay in your own home. Small things like that. But I started to think about how this affects people. If I'm an employee in JetBlue and I have a 401k over a period of time, and they have a flight attendants union, a pilots union, give them the debt. Don't give them the stock. This debt's going to yield 10%. I'd rather have that because on paper, equity is now worthless. I'm a JetBlue loyal person. My point is this. The airlines get rescued every time by the U.S. government, and they probably will again. But think about if they're not doing well now, how in the world are they getting? And by the way, they're only Airbus. They're not even Boeing. They don't have a Boeing plane. So they say all these, sorry, I'm getting exact because I'm going to lose all my loyalty points at some point on this thing. But my point is that right now, to Dan's point, the companies that either want to blame something or doing something, to me, it's more important. If you're not doing well right now, you're in trouble. That's I think my takeaway.
You got up to go to the bathroom on the plane? Were you flying to like Cambodia?
I don't do your thing. Well, a lot of storms. I was killing time. We were flying around storms. Never fly in the afternoon.
Let me make one last point about the recession stuff from Butters' work, and I'd love for him to go back and tell us like what was going on in 2022 or late 2021 in the same thing, because basically lots of folks were pricing in the bear market of 2022 a near certainty of a recession in 2023, right? And when you think about that, so it's interesting that we kind of flipped here from a certainty in 2022 when the market, I guess, was down 25-30% or so at its lows, right? And then 2023, it was just off to the races. So again, data that we want to track. John Butters, Senior Earnings Insight Analyst, Guy.
Love Butters. Love his work. This is a time of year, by the way, where you only really have baseball, Danny Moses.
Baseball.
But football's coming.
Yeah.
So you're the gambling DNA, that gambling chip in your mind
Hold
starts to
on.
work. And some of these stocks, by the way, have done pretty well. So go ahead and say what you want to say.
You're about to go where tomorrow?
Saratoga.
That's right. So you are a fan. Don't put it all on me. You like gambling on the ponies.
I like the horses.
Okay.
Yes, I do.
Well, FanDuel is very big in gambling on the ponies, which is the parent company is Flutter. And here's a perfect example of a name that listed on the New York Stock Exchange this year. So it wasn't in any of the, quote, passive funds. And the thing was literally left for dead for a period of time. They are destroying DraftKings. Less than half their business comes from the U.S. anyway. They're big in English Premier League for gambling. They're an online bookie for those people who don't know what Flutter is. About a $36 billion market cap now at this point. And they blew numbers out and guided higher. It trades at 10, 12 times EBITDA. It's not expensive. Not you, another company that's operating on all cylinders. But yes, as we go into the NFL football season, English Premier League kicking back off, you know, like you're in a secular growth area, Stu. The gambling stocks are in a secular growth area. The other name, Genius Sports, which I obviously reported. Again, small cap name got crushed in the sell-off 2 weeks ago. My exact point. Stock's up 30% off the lows in 2 weeks, but they're the tech provider, B2B and online games. So anyway, I like secular growth stories. So yes, Guy, I'm excited for the football season.
As you should be.
Yeah.
You know, again, I love John Butters. We love his work. You should get it in your inbox.
Yeah,
We
why
talk
not?
about it all the time.
It drops every
But I'll
Friday
say
morning.
this as well. A few weeks ago, I was reading the New York Post. Stu, you're a fan of the New York Post, right?
I do read it.
And I go through and I see something about, am I allowed to say this on the podcast?
If you go to the Urban Dictionary, it doesn't mean what you think it
Well,
means.
apparently there's people now that when they get on the plane, they get in their seat, predominantly men, and they stare straight ahead. That's something that I've been doing for the last 35 years.
I know.
I flew to South
traveled with you
Africa.
often. It's just the weirdest
Straight
thing I've
flights,
ever seen.
and I
done it.
sat
Freaks
in my
me out.
chair and I didn't move. Now apparently you can't fly from Orlando to JFK without getting up to take a
Because there
leak.
was such bad turbulence, I needed to kill time and run around the plane, and
And apparently they call it raw dogging. So I am the king. Apparently, like I'm the
king of
first.
raw
By the way,
dogging.
just to keep on the New York Post for a second, this was the financial headline the New York Post, and I want you to listen to this. The number of Americans filing new applications for unemployment benefits fell last week, followed by the following statement. Surprising economists and boosting hopes that the Federal Reserve will finally start cutting interest rates next month. That was it. I took it out, copied and pasted, just so don't believe everything that you read. This is how, you know, people putting these headlines together can't make sense of the markets at these points. But yes.
Probably a bot.
I love when Stuart Sopp comes on.
Yeah.
He's great. We enjoy his company.
English Premier League. You got to give us a prediction because we're going to have you on for a
does
while.
it start? Hold on.
It's starting tomorrow, I think. Who's playing Wolves? It's
I don't know. Don't
Man United. Is it Man United? Maybe.
I don't know.
And I've got Chelsea, Man City on Sunday, so I'm a Chelsea supporter. So
Who's winning it this year? Just give us the thing.
I think. Look, I think Man City is so dominant that they have obviously still a good shot. But Liverpool's right up there. They were gaining last year, and I think it's a pretty even race between Arsenal, Liverpool, and Man City. And so Man City, if they come out the gate slow, it could, I don't want to say. I can't believe I'm saying this, but it could be Arsenal's time.
The Gunners.
It could be the Gooners.
Isn't it crazy?
It
It's
could
a
be.
crazy long season. It starts
It is.
in late
Oh,
August.
yeah.
And then there's
it ends
tournaments.
all the tournament. Yeah, all the
Stu and I
summer.
have a little investment somewhere, don't we, Stu?
We do over in Italy.
Venezia.
Yeah.
Venezia, who's now in Serie A.
Yeah.
Guy, we
Look at
wanted
us
to
winning.
we wanted to do something that you were get involved in.
I'm
Italian
a fan
soccer.
of Tottenham Hotspur.
Yeah.
But that's for another podcast. Stu, we've enjoyed having you on.
Thank you,
Thanks
guys.
for joining us here.
Appreciate it. Thank you.
Stu, thank you.
Thank you.